Welcome back to the Williams Real Estate Channel. Today we're discussing the macro market update for the end of December 2025. And we can call this my prediction coming into 26 of where I see the markets heading at a macro level. So stay tuned. Lots of data in this presentation today. And it's quite fascinating to see it all unfold ahead of us. As you know, we use this 18-year land cycle as our framework to understand where we sit in the market. Being on that blue marker, equivalent point of time now would be coming into 2007 in the prior cycle. So we use this as our framework to understand where we sit at a macro level. And then from that, we then peel back the layers and work out where each sub-market, if it's a metro market, a region, a regional town, types of property, if it's individual units, villas, townhouses, houses, if it's blocks of apartments, commercial property, because there's not one property market, there's not one asset class that performs exactly in parallel to this cycle. This cycle is used to work out where we sit in the overall global economic business cycle. Some people call it the business cycle, the land cycle, the property cycle. There's an underlying 18-year rhythm, give or take. Obviously, history doesn't repeat exactly, but it rhymes. And this way I've found is the best way that I've used to manage my own investments, property, shares, cryptocurrency as the cycle plays out. So we use it to work out where we are. And then from that, we work out, okay, so where each market outperform as the cycle plays out. Obviously, if you buy any property, hold onto it for long enough, you'll eventually make money. But we're in the business of building portfolios. Within a short period of time, I'm up to 18 rentals in 7, 8 years of acquiring. So in order to get to that type of level in that period of time, you need to be chasing the markets where the growth is going to be in the near term. When I say near term, 3 to 5 years. Everything I've bought within 3 to 5 years has doubled, if not tripled in value. And that all comes down to timing, market timing, analyzing the data, but putting context to the data using the cycle. So as we go through these slides, this video provides you context of where we are based off the 18-year land cycle and where we could be heading. And if you view the world through the cycle, it'll provide you that clarity, allow you to sleep well at night, be prepared, not panic, and not have to be reactive. We are going through a time now where it is all very emotional. We even saw it, recently in Bondi, a wealth divide underway. People that have assets, property will prosper. People that don't will fall further and further behind. And they're looking for answers, people to blame. And this is where we typically see this type of behavior. If we look back, similar points of history in 2005, December 2005, we saw similar events with the Cronulla riots, backlashing from a Muslim person bashing some swimmer on Cronulla Beach. So here we are again. History is repeating like clockwork. So we'll run through the slides and it'll provide you clarity of where I see the markets are and where we are heading into the future. Starting off with the Australian GDP growth rate, it rose 0.4% in September quarter by 2.1% since September 24. So 2.1%, pretty average GDP growth. We see at the final stage of the cycle, as land price gets so high, rents get so high, it's drawing capital out of the system. There isn't any available funds for future investment or business activity, hence sluggish GDP growth is pretty common towards the tail end. Australian unemployment rate has been steadily rising since 2022. And if you look at long-term trends, once the unemployment rate begins to rise, it only continues to accelerate to a point where it just runs and spikes, like what happened in the mid-cycle slowdown in 2020, 21. Same goes for what happened in the GFC in 2008, 9, 10. I see unemployment continually rising over 2026 from here. Australian inflation rate has started to trend up. I was holding out on doing this video actually. I was waiting to get the updated inflation, but I just thought I'd just roll it out. We'll capture it next month. But as you can see, from June, it troughed out at 1.9%, and ever since June 24 has been rising 3%, 3.2, 3.6, 3.8 in October. So it has started to trend up and will probably continue to trend up over the course of 2026 as we continue to see the impact of high cost of energy. In the past 12 months to September, energy price of electricity rose 37%, which is pretty crazy. That's an astonishing amount for 12-month period. So that's going to continue to compound over 26, which is going to create more and more strain in the system, higher inflation, which is going to inevitably cause the Reserve Bank to hold in the near term. I don't see them dropping rates, and they're only going to be going up from here to tame inflation once again. So the RBA held the cash rate in December, on the 10th of December, and they made commentary around that inflation is starting to pick up and is broad-based again, and came straight out of Michelle Bullock's mouth that she doesn't see rates getting cut in the near term, meaning over 26, they're definitely on hold and will probably go up a couple of times, I'd say, in 26 and even into early 27. And if you look back at history, same moments in time, pre-GFC, late 80s, late 60s, inflation and interest rates continue to rise, which inevitably ends the cycle. So I'm tipping rates to go up over 26. Personally, I've already locked in, I'd say 90% of my debt at 5.5% interest only, fixed for 2 years. There has been a bit of a delay on fixing the whole portfolio. And even in the last 2 months, the fixed interest rates have risen now to 5.75%. So the fixed rates are already starting to go up, which is the banks pricing in, they're backing that rates, or the cash rate, to go up over 26. And that's not slowing the home loans being acquired by consumers. It's on the rise yet again. Not like the crazy cheap money we saw in 2020, 21, 2%. That's a massive uplift in loans. And then as they started to jack rates up over the last couple of years, it came back, but has since now started to trend up again. So loans is key. Loans is essentially creates the price of property. If there's more credit created into the market, it'll all get absorbed by higher land price and property prices. So we'll see credit becoming easily accessible. Banks over 26, 27 are earning higher profit margins. We're seeing the likes of CBA and all the big four banks hitting record high in terms of share price and market capitalization valuation. So that is all driven by higher rates, higher interest rates, creating more profit for the banks, more people taking on loans. That's all getting soaked up into higher land and property prices. That's feeding on itself, creating FOMO, optimism. People want to jump into rising markets, so people are taking big loans, pumping into the markets. And a lot of people, especially first-home buyers, I see, are taking on big loans, 95% loans, that they probably won't be able to hang on to long term. Here we are again. Pre-GFC environment, especially in the States, you could have gone into a bank and not even prove you got a job and get a loan. It's the final credit expansion before the inevitable land-driven downturn come probably by mid 27 and onwards, anytime. And it could be any time from here, but I guess we're not seeing the final euphoria, FOMO, crazy frenzy, which we typically see in the final 6, 12 months. We're not seeing that yet, but I see that evolving over 2026. It is definitely becoming more competitive on the ground to buy property. There's a lot of buyer activity, a lot of demand, but I see it getting even more extreme. Over 26, 27, peak market. Here we are. So buyers beware. If the banks will approve you of $1 million plus loan, that doesn't necessarily mean it's a wise idea to go and put that into one property, because 9 times out of 10, if you're paying over $1 million for one property with one rental income, you will be paying over the intrinsic value, meaning you are overpaying, in my opinion, for that property, and you could be waiting many years for substantial growth. And God forbid, the banks may even be asking for their loans back in the coming years when the market turns and rates go up and unemployment goes up. So buyers beware. Don't get caught up in the fuss. Australian totality dwelling price month on month. So this is totality data. As you can see, we've had a solid run over 25. I'm seeing it will continue over 26. We don't see the downturns like what happened in 22, 23, briefly in 2020, and the big credit crunch from APRA in 2018, 19. Typically, we see a slow decline month on month and then continue to go negative before a broad-based downturn. And we've pretty much seen solid growth throughout the whole of 25. And we'll probably see it for over 26. It will start to slow come late 26, early 27. This is something we definitely track to see the trends, but it looks pretty broad-based and strong and resilient at this stage. Property prices have hit a record high ever. Prestige Sydney real estate markets remains the highest price leader in the country. Lower value suburbs delivered the strongest gains over 25 in WA and Queensland. Perth, Brisbane, Darwin lead capital city upswing. Biggest gains for regional Australia was WA and Queensland over 2025. Prices fell by up to 14% in some regional areas, including New South Wales and Northern Territory. Mining towns in Queensland, WA have produced the highest yields as the rents have jumped more than 20%. Here we are again. Pre-GFC, the mines start to pick up, run hard, construction property hooks into overdrive. Globally, demand for Australian materials is high. Coal, iron ore, coal seam gas, all required to go into these massive projects globally. That sets off our mining sectors, creates big, high-paying jobs. the money all filters down to the benefit of land price and property prices in those regions. Hence, rents are going through the roof, big paying jobs, people FIFO, fly in, fly out, 200, 300, 400 grand plus, driving trucks around. They've got money, they'll spend money. It goes into higher rents, pushes values, and everyone starts speculating and buying up mining towns and thinking the party goes on forever until it doesn't. Here we are again. We've been here before. Affordability is at record lows. So it's obvious. I mean, with prices, rents going up so high, everyone's getting squeezed. We've been here before. This is all commentary out of Cotality and data out of Cotality. So if you want further on this, subscribe to them. They've got many articles and many data points which we use. Australia has the lowest productivity in a long while, whether or not on record, unsure, but definitely the lowest growth rate in the last 20 years. And this has been driven by big government and big spending. So big government, I mean, I'm not here to bash the government. I worked for government towards the tail end of my career. I worked for a land and property developer that was owned by New South Wales government. I can't name them as they threatened to send me legal letters, even though I fucking know they never would. It'd be on Current Affair before they know it. Free marketing. Bring it on. Let's go legal. Let's have a legal party. Ah, shit. But I mean, big government, when I worked for this state-owned corporation, that compared to the private market, I couldn't believe how many employees they had. And that's when I was working 2, 3 years ago, 4 years ago. And compared to working with a builder developer in the private industry, they had easily more than double requirement. They had 400 employees. They could have done it with 100, 150. The same output, same productivity, same project, same shit. Even if they had the right people, better people, they could even do more of an output in terms of land and property development with half, if a quarter of the staff. It's just absolute outrage. It's like there's no different across the board. I've experienced it working construction property, even working with doing work for the likes of Sydney Water. It's a effing nightmare. When I was in construction, we were building big water treatment plants. I was a contracts manager for a number of contractors, one of which was Enviro Pacific. We used to punch out water treatment plants for Lend-Lease. We did all the remediation work down at Barangaroo. And we built massive water treatment plants, 25, 30 litre a second plants, just 5 or 6 of them, while we did all the other remediation works with groundwork services, piling, dig and dump, treating, on-site treating. Anyway, we built these massive water treatment plants, 6 months, threw them up, commissioned, got them running. We did 5, 10 litre plants, so a quarter of the size water treatment plants for Sydney Water. Took us 2 years, and then another 2, 3 years of legal dispute. It's a nightmare, absolute nightmare doing anything for government and even getting the government to deliver on stuff. It's just the amount of policy, regulation, red tape, and the people aren't the best people. It's honestly like working in a nursing home. It's fucking retarded. So I see that. I've experienced that. That's my experience working in both private and public organizations, that there's big government. It needs big cuts and they spend a lot of money. So that's ultimately sucking resources from the private industry, creating these jobs that, they're not actually delivering much work. It's just a lot of people bums on seats. It's the reality of the situation. So that's creating this ever slower productivity growth, rapid population growth as well, as we keep importing more and more people into the country, lower skilled migrants coming in. So rapid population growth as well contributes to lower productivity. Not that I'm complaining about rapid population growth, because that plays into the hands of property investors. That pushes up rents push up prices. So keep pumping it up, but it's not the best for the community, and big strain on infrastructure, roads, tunnels, schools, hospitals, housing goes into that. So it's not the best. I mean, I would trim it back a bit, but it is good for property investors, mate. That plays into the hands of, if you import more people, that's demand. They all need to live somewhere. So if you buy the affordable stock, flats, blocks of flats, you'll always do well, provided you're buying at the right price, right yield in markets that are set to grow. High minimum wage. We've got the highest minimum wage in the world. So Albo comes in, jacks up the minimum wage, thinks he's doing a good job. But what that does is it increases cost to businesses. It squeezes businesses. It doesn't incentivize people to work harder for more money if they're just continually just getting raises after year without actually providing a return or hitting any KPIs. They just get an automatic 3, 4, 5% rise. So that squeezes productivity. High energy costs, so the obsession with net zero, not building any more coal-fired power plants, pushing the renewable agenda, that pushes up electricity costs as there's a lack of electricity supply, not meeting the demand. I'm going to do another video on this, and I think this is going to be the reason this time round for the end of cycle. What's going to prick the bubble? It's going to be energy costs. Energy is going to go through the roof, just like in the 70s, we had an oil shock where that ultimately was the pin that popped the bubble. This time around, energy, and it's already happening. It's been happening for, especially over the last decade, 15 years, as they continue to push towards renewables. It's crippling the economy. Low business investment caused by high energy costs. If there's high energy costs, you can't make a profit, can't make a new product stack up in terms of creating it, manufacturing it, selling it to the market, then the private sector doesn't adopt new investment into new technologies or adopt new technologies to create that into the market, which causes shrinking manufacturing sector. I mean, we don't sell cars anymore. We used to. 5% of GDP is manufacturing in Australia. Can you believe that? It's nothing. Slow income growth and slow GDP growth. And I mean, I threw in another snapshot that came up the other day, welfare payments. So again, Albo's pumping more money into the system. Keep pumping it, Albo. Keep pumping it. The more money he hands out to the likes of youth allowances, unemployment allowances, the dole payment, pension, carers, so a single mum now can make over $1,000 a week when they add it all up, all the rental assistance, the dole payment, carers allowance, whatever they get. I've got probably, I'd say, at least half a dozen people on the rent roll to our investments that have definitely, probably half the rent roll would have some sort of government assistance. Just like water finding its level, all these welfare payments end up into the hands of property investors as rents will continue to rise. If people have more money, they'll spend it on rent. So keep pumping it, Albo. They'll keep pumping up rents, which will keep pumping up property prices. Now, what's going on in the US? The US is key as the US leads the global market and the US is pumping. Q3 GDP is up 4.3% in one quarter. Can you believe it? Compared to Australia, we wouldn't even do that over 12 months. We're doing 2.1% over 12 months. They did 4.3 in a quarter. So the US is pumping. Their unemployment rate is steadily rising. as well. So it troughed out in 22, 23 and has been steadily rising up to 4.6%. So something to definitely keep an eye on as this continues. Probably will continue over 26, will continue to keep steadily rising. The US inflation rate, I don't know what was going on with the data. Something happened in October, but it has come back a bit to 2.7, but is still elevated above the Federal Reserve's target of 2%. Touched 2.3 in April last year, but has since been well above 2%, even in 3. And I suspect inflation, as we are at this point of the cycle, over 26, 27, to continually be over the target and even rise into 3, 4, 5% come the end of 26, 27. So I see inflation being elevated in the US. We'll import some of that higher inflation into Australia. And what I can't work out is what Jerome Powell is doing. He's probably trying to save his job. They've got inflation up above their target of 2%. They've got unemployment rising, yet he's dropping the cash rate. So he's obviously either favoring the unemployment rate, which is steadily rising, as these two indicators is what they use, is unemployment rate and inflation. Inflation's going up and unemployment's going up. So he's, I guess, justifying cutting rates based off unemployment going up. But what this is going to do is it's going to create confidence. It's going to stimulate the market. It's going to bring more cheap money credit into the system, and it's going to set off another wave of inflation. Here we are again. Sounds familiar? And his time's up as of May 26. Whether or not Trump will kick him out, yet to see. It has died down a little bit. Hasn't really been spoken of much as of late, probably because he's cutting rates. So time will tell. But if he does kick him out, Trump will line up someone that is favorable to drop rates, and that is only going to send it off its heels over 26, 27. Trump wants low rates. He's a property guy. He knows low rates, pushes up asset values, cash flow's not better. Holding cheap money on real estate is great until the party ends, and then they end up having to raise them higher to tame inflation. And hopefully we don't see a pickup like in the 70s, triggered by a drop in rates, which is definitely not needed at this stage of the cycle. The time will tell. See if the US keeps dropping the cash rate. But I don't believe the RBA in Australia will do the same. I think they're pretty independent compared to the oversight that Trump is having on the Fed in the US. He's a property guy. He's doing it for his vested interest. He wants low rates. So you can imagine if rates get back to 2, 3% over 26 in the US, what's that going to do to the markets? It's going to absolutely pump it. Stock markets continue to rally all-time high, which is good. They'll probably will continue to keep rallying over 26 and even into 27. Historically, stock markets continue to rally at least 12 months longer than the overall land market. Land market's due to top out over the course of 26, probably late 26. And we'll probably see the stock markets continue to rally into 27. Come 28, shit is going to hit the fan. Bitcoin has taken a bit of a hit in the last couple of months. Bit of panic would even make a seasoned gambler quake in his boots. And what I find is quite interesting is Bitcoin was never really tested in the prior land-driven downturn throughout the GFC. So it's anyone's guess whether or not it will survive throughout the next land-driven downturn come 2028 and onwards. I'm not so sure. There's a lot of big players, including Warren Buffett, that don't believe in it. They think it's just speculation on steroids, more buyers and sellers. But when there's more sellers than buyers, when people need money, it could go to zero. There's not anything intrinsic value behind it. Not like owning an apartment building or a house where you've got bricks and mortar or shares equity in a company. It's the blockchain, the woozy wuzzy, it's whatever anyone thinks it is. So could it be the future? Who knows? But I'd say most of these cryptocurrencies are going to get wiped out come 28/9/30 towards the end of this decade when people need money, when they're trying to liquidate everything to raise cash to shore up their balance sheets. Crypto will be the first to be sold. And when there's more sellers than buyers and there's nothing intrinsic value behind it, it's just a Ponzi scheme. It'll probably go to zero. Whether or not that's happening over 26, I don't believe so. Even though there's a couple of indicators that could well have topped in 25. Bitcoin topped out in 17, December 17, 4 years on, it again topped out in 21, 4 years on brings us to 25. So that could well be the top. But where we are in the 18-year land cycle, we're coming into the final stupid, crazy year or two where we'll see probably another run hard. All the euphoria coming in, all the latecomers, all the punters right at the end, as all the longer term holders are selling out, all the punters will be rushing in with the FOMO, as they do, not just Bitcoin, but every asset class. They charge into the tail end and end up learning the hard way. We're not saying I'm a trader or a Bitcoiner or anything like that, but I do know a few things about trading, as I do have money and do dabble a little bit here and there. Not that I'm in any of this stuff anymore. I've long sold, but this is showing signs of a higher low than what happened in 23, 24. So if this continues to stabilize out, then that's bullish for another run, which we'll probably see over 26. I'd say Bitcoin's going to continue to run hard over 26 and even into 27, but come 28, that's going to be the question. Is Bitcoin going to zero in 28/9/30? Time will tell. Now, Trump is close to a Ukraine-Russia deal, which is good to see for humanity. Stop all the killing. So hopefully this is wrapped up soon. So what's setting the stage for the deal? Ukraine is going to give up control of some of their land to Russia towards the southwest of Ukraine. US is to provide a 15-year security guarantee to Ukraine to protect them against Russia. Ukraine has already provided the US with contracts to mine rare earth material. So that's how they'll be paying for it. And if this all pans out and the deal is made, then this will set the stage for the euphoria, the confidence coming back into the markets. There's no more wars. If Trump manages to do a clean sweep, clean up all the wars, this will be it. The final euphoria is here. We're coming into it. This will be the year Trump declares he's created the best economy in history globally. So typically we see at the tail end of the 14 years up in the 18-year land cycle, we see a prominent figure such as a US president stand up and declare that they've created the best economy in history. He's already saying certain phrases like he's creating the best economy with the more money's coming back into the States than it ever has been, which is true. And the US is the hottest country in the world. So I think this will be his final tick to get this done. create the euphoria, create the optimism, and everyone will think we're on to the next wave of growth cycle. He'll declare, stand up in front of everyone, tell everyone how good he is, and declare that he's created the best economy in the world. That will mark the top, probably towards the tail end of 26. And then it'll be any time that something will pop the bubble and we'll end up heading into the next land-driven downturn. D.R. Horton, the largest home and land property developer, home builder in the States, continues to lose steam. To date, D.R. Horton has lost 24% over 15 months from its peak in September 24. And if we look back at a similar point of history, D.R. Horton also lost 66% from over 27 months, from July 2005 to October 2007. That happened before the entire broad-based stock markets topped out. So this is a leading indicator. This company prices in lower earnings as land price starts to soften. And as it continues to soften, their share price is tipped to continue to lose value, which is a leading indicator for the overall market to top out, as this will be a land-driven downturn. Land price going down, that's going to drive the fear into the market. That's what's going to turn the tide. As always, this content is by no means financial advice. It's just my thoughts, my processes, my story of how I see the markets heading into the future. Please remember that this content is general in nature and is not personal or general advice. Prior to making any investment decision, you are to seek independent advice in relation to the purchase of any property or any asset for that matter. This is by no means financial advice. I'm not a financial advisor. I don't provide financial advice. I just put general content out there of my story, of how I see the markets heading into the future. Take it with a grain of salt. But if you wish to engage us or shoot us an email, we can jump on a call. If you need help buying an investment property and navigating the markets ahead, it's going to be turbulent times. There's not every market region type of property I would buy personally in 26. And the three main factors to getting it right are buying real estate for at least half, if not a third, of the intrinsic value, strong yields, 6 to 8% in markets that are set to grow based off long-term trends, and overlaying it with historical sales data and using the 18-year land cycle to guide you all the way. Don't get caught up in the fuss. This is not the year to get all FOMO and emotional and think you missed out. There's always time to buy property. There's no rush with this stuff. So hope that helps. Hope that gives you context. But I see 26 being a bullish year for all asset classes, stocks, commodities, gold, silver, real estate. Everything's going to be pumping, but be cautious of what you get yourself into, because we are close to topping out this time around. Till next time, thanks for watching.